My name is Michael Guyette, publisher of the Lead Lag Report. Joining me for the Rough Hour is the resource maven herself, Gwen Preston. Gwen, introduce yourself to the audience. Who are you? What's your background? How'd you get involved, interested in markets, in mining, in commodities, and what are you doing currently?
Awesome. Thanks so much for having me, Michael. And thanks. Hello, everybody who's listening. Super excited to be here. My name's Gwen Preston. I write a newsletter called The Maven Report, or The Maven Letter. It's funny you said Lead Lag Report, so I had the word report in my head. The Maven Letter, which is about opportunities in mining investing. So my whole investing focus is metals and mining. That spans starting in the gold side all the way across through the base metals and into what you'd call, the pure energy metals, lithium and things like that. And I start from the tiniest companies, those who are searching to make new discoveries, the really speculative opportunities in the metals and mining space, all the way up through the bigger opportunities and trying to help people who see, when they see opportunity in metals in general, understand how you can position your portfolio for that. The way that my letter works is that I write about what I'm doing with my money, what I'm buying and what I'm selling. So I track my portfolio and I write about my thoughts, what's going on in the space, what I'm seeing, what I'm understanding. I mean, that's important in every investing arena, but in mining is one of those ones where, there's a lot of information that's needed to make sense of the space, especially if you're in those speculative high risk stocks, because it's a lot of geology, but combined with jurisdiction and capital market flows and all of those things that matter. I try to help people understand that because there's a lot of people who really like investing in mining, but it can be an all-consuming job. So I make it my job and I try and share what I learned, what I like, who I know with my subscribers. So I don't take money from companies from coverage. I just try and help other investors who are interested in mining hopefully make some money at it. My background is chemistry and journalism. And then my first job that I got out of my master's degree in journalism was at a newspaper that was all about global mineral exploration and development. And I got my feet very wet there for 6 years. I wrote about that. And that was from sort of 2007 to 2014. So that ended up being some crazy times in the metals and mining space. There was a bull market, then there was the global financial crash, and then there was another crazy bull market, and then we went straight into a bear market. So I got to see those cycles compressed. I got a fast forward version of what people usually have to spend much longer learning or experiencing. And as we were in 2014, I looked around and I figured that the markets had to turn up for metals at some point. So I left my salaried pensioned job there and started my own newsletter. And I've been doing that now for 8 years and I love it. So I'm excited to be here, talk about metals, talk about what's going on, what the opportunities are, what sort of timeframes I see for those opportunities, answer any questions that people might have.
So you talk about how they were kind of multiple cycles, bull bear, and now where we are today. Any interesting similarities across what you saw from 2007 to 2014 and then to today that is sort of paralleling anything else in history? I'm trying to get to the question of, are there similarities in cycles or are these cycles different?
Oh, aren't the words "it's different this time" the most dangerous words in investing? I say that tongue in cheek though, because it is different this time in that the monetary forces in the markets have grown so far beyond what they used to be. When we talk about mining cycles, we love to look back at, the cycles of gold and silver, in the 60s, in the 70s, in the 90s. And that's interesting for sure. But the monetary forces were not in play there. And by that, I mean all the quantitative easing and all the huge amounts of liquidity that are pumped into the market now by the Fed. So those have changed the dynamic, no doubt. And so there are definitely some parallels to following the great financial crisis, but at the same time, it is also different because all of that monetary fuel has fueled the broad stock market since really the great financial crisis, and then in a bit of ebbs and flows through to COVID, and then certainly in the post-COVID run. And then I just today was writing about how I think liquidity, the Fed injecting liquidity by making it easier for banks to access loans, injecting liquidity on that side of things, despite, with the other hand, still raising rates, so tightening and easing at the same time. I think liquidity is one of the key reasons that markets are continuing to rise today and are perhaps that's how they are trying to navigate us to this soft landing. And all of that really matters for me as a metals investor because the base metals fundamentals are ridiculously strong. We have nowhere near enough copper, zinc, lithium, uranium, silver. There's more. Those are some of the leaders to fuel growth, to do what we need to do for growth. And that encompasses the green transition, which is just part of what growth now is mandated and what's happening. So the bull market, the supply deficits are just entrenched. They're very real. They're shockingly large, but base metals aren't getting any love. And that's because investors are some combination of still wary of a recession, and people don't generally invest in economic growth when they are thinking about a recession. So that's holding people back from the base metals side of things right now. So it's some combination of that and this continual injection of liquidity, maintaining the kind of tech-focused investing that has been so dominant, especially since COVID, right? And so that's, call it AI, call it the leadership of the large caps in tech, that's keeping that part of the market very much going as well. So those things have kept interest away from base metals, even though the fundamentals there are insanely strong. Sorry, I totally riffed there. I don't.
No, that's good. Okay. But I feel like there's a couple of directions to go with it. So first of all, do you consider gold as maybe a different class or category against base metals?
Completely. Yeah, I think the gold can often get carried along a base metals bull market, and that's an interesting thing that happens, even though the gold arguments are completely different. So if we end up in a growth scenario and we end up in this base metals bull market, I expect gold will participate in that as a metal. It wouldn't sort of outshine, but it would participate. But the flip side is not true. Gold can certainly go on a bull market run without base metals also going with them, because the argument, the rationale is so different.
Right. And to your point about rationale, I think the institutional reasons for gold versus copper, for example, or other industrial metals is different dynamic.
Are almost
right. Exactly right. I mean, I've long made that argument that, gold probably need the belief that you're in a prolonged bear market, because gold doesn't really correlate to equities, the 60-40 dynamic. And unless people believe, institutional players, big money, really believe that you're in a prolonged bear market where they need more diversification, which gold fits under because of the non-correlation aspect of it, it's hard to get that sort of divergence against everything else.
Exactly. So I think that's exactly the rationale that fuels the gold-only bull market, and that is a very real thing, and it can be pretty exciting, especially because, like you just said, that opportunity arises when other opportunities are not working. So that sort of maybe even underlines the gold market opportunity. It makes it stand out even more because it happens when others are not. But then gold can also, when there's that overall growth scenario and metals are going on a run, think of sort of 2007, 2006, something like that. Gold got carried along with that because commodities as a whole became a thing. And even though it isn't a commodity, when commodities are grabbing attention, gold gets lumped in with them as well. So maybe that's because of investing in miners, and gold becomes part of the investing in miners. So gold gets carried along in that base metals market, but absolutely not the other way around.
Since you mentioned miners, let's talk about the miners side. Now, I'm much more of a quant than anything else, despite the way I phrase things on Twitter. I'm a big back test and kind of testing things out. But I've done all kinds of tests to try to see if there's any real trading strategy around the price movement of gold to the equity gold miners. And I have to tell you, I don't see anything that suggests that gold leads the miners. But a lot of people seem to believe that. Lay that out from your perspective. I think this is one of those hard dynamics when it comes to wanting to be bullish on the miners. If there's no clear link to gold itself, then what is it based on?
Yeah, I mean, I think there used to be more of a correlation, and I think right now gold does not lead the miners as a group. Gold leads the gold miners, sure, but gold does not lead the miners as a whole. And what's somewhat depressing for those of us who are focused on the metals and mining space is that these days gold leads the miners so much so that the miners aren't really following. It's like winning the race, go gold, except that's not what we want, because we want the stocks to go. We want the stocks to offer us leverage. The reason, gold is doing really well for a couple of reasons. Going back to last year, there was a lot of broad retail buying of gold as that hedge, that diversification, the way that you referenced it. The other big thing that was moving the spot price is that central banks are buying gold hand over fist. It's insane, actually, the increases in central bank buying over the last few years. And that has everything to do with the gradual, slow, but nonetheless very much underway processes of de-dollarization and deglobalization, right? I don't want to talk about de-dollarization. It's a very slow thing, but it's happening, right? And one of the key things that countries need if they want to over time move away from the dollar is to have a gold reserve. That's one of the big alternate modes of transaction and security. And so central banks are buying a lot of gold. And that has really been one of the things that supported the spot price. But central banks don't buy gold stocks. So that's a key force in the gold space that's not benefiting the stocks side of things. And last year, when retail investors or investors were buying, as opposed to central banks, were buying gold in 2022, when stocks were suffering and there was that hedge factor for gold was very much alive, those investors were also buying gold stocks because that's what you do. You either buy gold metal or you buy gold miners because you want exposure to the metal plus, as in plus leverage. If the gold price goes, then miners should offer leverage to the upside. But there's just not as much of that hedging action going on right now. There's much less perceived need for hedging. And yeah, gold is doing fine. It's holding up. I mean, the last few days haven't been great, but it's trading up, between $1,850 and $2,000. That's a great range for gold, but it's not doing anything exciting. And the miners are doing even less exciting things. Over on the base metal side of things, I do think that prices lead the miners. So the copper price will lead copper miners and the uranium price will lead the uranium miners. But then, we can get into those weeds if you want, but I'm getting past the question.
I was going to ask you that question. If there's a stronger link, right, among, the silver miners to silver, or maybe, to your point, copper miners. But if that's the case, I guess the question is, and maybe this is just sort of a naive question on my end, but why even bother with the gold miners at all, right? If that's the case, if you can't find as clear of a link like you can with other base metals and their respective miners, why not just trade those?
For sure. So I think if you get conviction that the gold price is about to make a significant move, whether because of, economic conditions slowing down and people wanting, money wanting to hedge stock market declines, or because there's been a recession and gold, the metal, moves first and hardest out of a bottom relative to almost any other arena. If you get conviction that gold is going to make a big move, gold miners inarguably offer multiples of the gold price move, right? So if gold moves from, $1,800 to $2,000, that's a gain, but it's not that much of a gain percentage wise. Whereas even the largest gold miner in the world, Barrick, will give you 3 or 4x the percentage gain that the metal will give you. And that matters for sure. Like I say, if you have conviction that gold's going to make a big move, then you want to bet on it, right? You want the leverage side of it. But when gold is sort of holding ground, just treading water. I like that I just mixed those two together and said that gold was holding water. That doesn't even mean anything. Anyways, if gold is just holding its ground and you just want to have some safety in your back pocket, like some gold in your back pocket, that's just owning the metal or an ETF, a physical ETF. That does the job without leaving you then exposed to leverage cutting both ways, right? If the gold price slides, you also were going to lose a couple X on owning the gold stock. So I think it has to do with conviction. If you're really sure that gold is going to make a big move, then sure, it absolutely makes sense to own the miners. But if you're owning it as a general diversifier in your portfolio, then having exposure just to the metal makes a lot of sense.
A couple of questions in the thread from Exo that I'm going to just say out loud, but basically I'm going to ask the question of your thoughts on copper on a go-forward basis, and then iron ore as well. And I'm going to assume that the impetus there is, the recession calls, in quotes, have been pushed out, which means, if they're constantly being pushed out, do you want to wait for when you're already in a recession to buy them or try and trade them here?
It's a very good question. And I wish I had a crystal ball to know exactly the answer. Even a couple months ago when, the recession, the recession seemed more likely, the calls were closer term, I would have said, why don't you wait for the bottom? I don't think anything much is going to happen until we go down before, and then it'll be time to ride it back up again. Now, because of this, what seeming delay, like it does seem, I mean, you can argue yourself both ways. I know I know there are these arguments both ways across your audience and all over the place about whether the recession is coming or not or what's happening. It does seem like it's not happening tomorrow. It does seem like there's an opportunity here for investors to consider that we might be going into a soft landing that turns into growth. We'll see. I actually think that we need to see expectation of rate coming down. So we need to see something like the 6-month yield start to come down before we're likely to have confidence that we've actually achieved a soft landing. But anyways, if market participants, some significant group of market participants really do start to believe and buy on the basis that we are in a soft landing and there's a period and we're going to be here for a while. Recession is going to still come at some point. It always does. But that we're going to be here for a while, that we're actually looking at growth and we should start forward investing based on a growth scenario, then it's time to buy copper right now. It's time to buy copper miners and uranium and nickel and silver right now. We're still in this weird don't know phase. Anytime you get a piece of data that pulls that recession risk back to the fore, then all of those, then the copper and uranium and nickel and silver, then they all take a step back. So at this point, it's still unclear. I can't give a definitive answer on that question. Unfortunately, the medium term, I can give a very clear answer on. I just can't tell you exactly when to time your entry.
Yeah, I got to imagine that China maybe complicates the conclusion there a bit, right? I mean, everyone talks about inflation, disinflation in the U.S., but China, if it doesn't start to stimulate, risks outright deflation. When you look at some of their inflation stats, which probably means they probably have to stimulate. I mean, I think there's some expectation building that's going to be the case. And China's a big driver of commodity demand, obviously.
Yeah, for sure. I mean, even just today, I saw some interesting headlines about how we have to look past China as the major source of commodity demand. And I'm like, well, you might say that, but let's remember scale here. That said, certainly the last crazy metals bull market, right? The 2004, 5, 6, 7 bull market was absolutely the China growth story. And that engine was immense. And I don't think that we are going to get that level of engine, that level of rev from China in the near term, because we all know lots about overbuilding and the government there now being wary of redoing that somewhat failed experiment. So I don't think we're going to get, I do think that it's likely that Beijing steps in with some kind of infrastructure stimulus. I think because of the risk of deflation that you were just saying. But I don't think it's going to be dramatic. And I think we're going to have to look for, I think that the realization of copper shortage, nickel shortage, lithium shortage, all of those is going to have to come. People are going to have to get comfortable with that no matter what's going on in China. And of course, that I shouldn't say no matter what. As long as China's doing okay, right? Demand from China doesn't have to be shooting to the moon. It just has to be chugging along because the fundamentals are so strong. Like the supply deficits are so significant for most base metals that China doesn't have to have dramatic growth. It just has to chug along for those things to require significantly higher metal prices, because that's what we need to motivate new mines.
The thing is, if you're going to try to motivate new mines, I have to assume the price has to be high enough to also counter the cost of capital, right? Which, it's now kind of battling against that. So historically, how does that sort of supply-demand imbalance factor into just the direction of interest rates and how high or how low? I mean, I've got to assume that, sure, there might be demand to get more extraction and more mining activities going, but maybe people or maybe institutions want to wait until rates are lower to actually do those projects.
Yeah, interesting point. I can't say that past metals cycles, in general, metals cycles happen because of demand, right? They're demand driven. So like I say, like the China cycle happened because of demand driven. And the force there in the past few metals markets has been so significant that the cycle happened no matter what was going on with rates and cost of capital, because the demand was so strong that you built mines to fill it. Here, we're not facing like I say, we're not facing a significant ramp in demand. Yes, demand for these metals that I keep mentioning is absolutely going up. And that's right now not being powered by a particular country expanding dramatically, but because of the green transition and what that does to copper intensity, like intensity of copper demand, of nickel demand, of lithium demand, and whatnot. So the green transition is the driver of demand, but this time it's coming up against, in particular, a market that hasn't built new mines. I say that as it sounds like almost too simplistic to just say a market that hasn't built new mines, but there's a couple of very clear reasons why there has been a dramatic slowdown in new mine builds over the last almost decade that's put us into this deficit situation. And even though we don't have a new China stepping in to create that huge demand pull, we are now instead in a supply deficit situation. And the green transition is the demand pull. The global green transition is the demand pull. And so I think it'll end up the same. And I don't think that cost of capital is going to be an impediment once we get to the point where there's a general understanding of how little metal we have versus how much we need.
I think you had mentioned lithium. I think that's a good area to kind of touch on. People don't, I think, fully appreciate sort of the really interesting supply dynamics when it comes to lithium and parts of the world where it tends to be concentrated. So lay out for the audience, first of all, the importance of lithium. Okay. I mean, people hear lithium ion batteries, they don't really understand what that means, right? But then also the geographic aspect, I think, is important to kind of touch on.
Absolutely. So lithium, I like to set the stage for lithium by saying that 20 years ago, we used lithium for very few things. There were some applications in ceramics, and there were some applications, but they were very, very modest. Now we use lithium for almost every battery in almost every electric vehicle. And the scale of the pace and scale of growth in lithium is hard to wrap your head around. It's been really, really immense. So that's lithium. So that's the scale of lithium demand. Lithium is pretty common in the Earth's crust. Like there's a fair bit of it around. As with any mineral, it's a question of finding it in places where it's concentrated enough and where it's physically or chemically reasonable, economically, to separate it, right? To purify it and into a state that's usable. And so with lithium, the classic sources are the Argentina, Bolivia, the salars. So these big salt flats that have brines involved that are high in the hills. And it's a pretty simple process. You pump out the brine and you let it evaporate. And the salt that's left behind is very rich in lithium. And then you have to purify those salts and you get your lithium. That works. There's pros and cons to it. It's low cost to operate, but it's high cost to set up in some ways because you need so much space to do all this evaporation. It's also really slow because you're literally just waiting for the sun to evaporate the water. So it's not an efficient way of producing lithium. And when demand is ramping up so dramatically, one of the things that we really need are efficient ways of doing that. Also, there's questions about water and pumping from brines and what that does to aquifers. And we're talking about doing this in places in the world that are very dry. So there are lots of questions or impediments to brine production of lithium. It's a very significant part of what goes on, but there's definitely restrictions on how much that can grow. Lithium also exists in hard rock. So there's a couple kinds of rock, lepidite and spodumene. Spodumene is the one that you might hear more. These are the kinds of rocks that also host lithium, and that's a more conventional mining operation. You dig up the rock, you crush it, you mill it down, and then you use some sort of chemical process to separate out the lithium. These things all work because it's a commodity for which demand has ramped up so dramatically. There's all kinds of new technology that is in the mix, and its eventual success rate still undetermined. Direct lithium extraction, so DLE. If you do some research into lithium, this is a term, an acronym that you'll come across. DLE stands for direct lithium extraction. And this is a way of, instead of those brine solutions, instead of just waiting for the water to evaporate, this is a way of extracting the lithium directly from the brine. Now, I did my degree in chemistry. this is literally just chemistry. And I say that it's simple in some ways. It's just chemistry, but every solar is different. Every brine is different. All the requirements are different. And it's a brand new processing technique overall. So imagine, figuring out every different brine on a chemistry bench and then trying to develop a massive processing facility that costs $1 billion to build and hoping that your calculations are right. That is basically what's going on with direct lithium extraction. It sounds like a tangent, but I say all of that because forecasts for whether we're going to have enough lithium to meet demand hinge on direct lithium extraction. Those in the space who are very optimistic on direct lithium extraction and who think a lot of the projects that are relying on that, even though they haven't yet figured out the chemistry for their particular brine, but a lot of the analysts who assume that those things will be figured out are the ones who think that we're going to have enough lithium to meet demand forevermore. Those who are less confident in direct lithium extraction, especially in its success in the near term, call that maybe the next 10 years, those are the ones who say, we're not going to have anywhere near enough lithium in the next 10 years to meet demand. And so perhaps so that's sort of the brine side of things. The hard rock side of things is another thing entirely. It costs a lot more to set up that hard rock operation because you got to set up a process plant and you have to have the permit to do a huge open pit mine, right? These things are very slow. Permits for open pit mines anywhere in the world are very, very slow to happen these days, right? And you need to be able to, finance a big process plant and all of that. But they happen. And there isn't the chemistry question involved. It's conventional mining. It costs a lot to set it up, costs a fair amount to operate it because, you got to run trucks and diggers and all of that stuff. But once it's going, it's probably going to be just fine. Because lithium was such a small industry for so long, and there were so many of these salars, and we had the time to just let brines evaporate, there wasn't a lot of focus on looking for spodumene deposits. There was, certainly. People looked for spodumene deposits. The Greenbushes, which is down in Australia, massive spodumene mine. I'm not saying that they didn't happen. They did. But there wasn't a focus on finding new spodumene deposits because there wasn't the demand. That, of course, has changed in the last 5 years, whatever number, 8 years. And now there's a real focus on finding economic, viable spodumene deposits. And I would say Quebec, the province of Quebec in Canada, is a really good example of that right now. There's a spodumene staking rush going on in Quebec because it's been realized that there's a whole bunch of the kind of rock that usually hosts the spodumene deposits, or the kind of formation, it's called a pegmatite. So it comes up and there's a realization that there's spodumene hosting pegmatite all across Quebec. So now it's all kinds of companies are going out there looking for it, because those are going to be very valuable deposits when they can be found. There's a company called Patriot Battery Metals, which is the prototype for that. It went from, I don't have the numbers exactly, but something like 30 cents to $15 in the last 2 years, because it discovered and delineated precisely one of those, a spodumene deposit in Quebec that's got enough grade, it's going to make sense, and it's going to feed into this lithium market. That's sort of the setup. There's more details that you can get into about how China controls processing and things like that. But for the investor who's interested in lithium, I would say that the opportunities sit with assets that are likely to feed the lithium supply gap in the next 10 years. And so those could be new discoveries like spodumene discoveries in Quebec, or they could be the kinds of projects that are at the point now, discovery's been made, a bunch of drilling's been done, but they're showing that critical mass, or that that the chemistry works, or that the metallurgy works, that it's going to happen. Those are the kind of opportunities that probably are going to hand out some nice returns to investors. Lithium prices came off a lot in the second half of 2022 after an astronomical rise. And that was fair. Every astronomical rise needs to take a breather, and it took its breather and stepped back. But now they're on the rise again because of the realities of supply and demand, and because some of those direct lithium extraction projects struggled. So I think there's definitely a second chance. There'll probably be more than just this second chance for lithium investors. So you just have to sort of decide how you want to play that opportunity.
how do you play lithium? There are a couple of ETFs, or at least one, I know the LIC ETF, but any sort of maybe secondary or tertiary ways of trying to play lithium, maybe without the direct exposure?
Oh, I mean, the way that I play lithium is through finding companies with lithium projects. Certainly, like you say, there's lithium ETFs. In terms of companies that have projects, I mean, as always in the mining space, there's just like metals go through cycles, projects go through cycles, right? The discovery phase is really exciting and you get a lot of price appreciation as a discovery demonstrates its merit. And then usually the price comes off, the value drops dramatically for a bunch of years when they do the really boring work of all the infill drilling to demonstrate, to know what the deposit really, really looks like on very tight spacing, all the engineering, all the permitting, which can take roughly forever. So, the value falls off because it's just straight up boring. And then the value usually increases again as the mine is being built and entering into production. And so if you can identify stocks, lithium stocks that are on one or the other of those upswing phases and the discovery initial delineation of a new discovery phase, or the building or operating a new mine, potentially a takeout target type mine, then those I think are the two ways that are exciting to play lithium. And so the discovery side, I mean, I certainly have some opportunities that I'm following in that Quebec discovery frenzy that's going on. Sigma Lithium is a good example of one that just built a new mine. And it's actually pretty hard to find companies that have built new mines in the lithium space recently. And so Sigma's down in Brazil, their mine. They have a simple mine. It's very green, which works well in that lithium world where, those who are going to be buying the lithium probably want to have green credentials associated with the commodities that they're using. And it's a very low cost operation. And most importantly, it has dramatic expansion capabilities. Like they built the mine so that it can be tripled in size with modest capital expenditures from here. It's a real takeout target. So I think finding opportunities like that are the way that you can really lean into lithium if you want. If you just believe in lithium, absolutely. Like you say, you can buy, a physical ETF that has exposure to the price of lithium. But I tend to lead into the stock opportunities.
Of all the different areas, different commodities that you cover, which ones have you seen have the largest supply and demand imbalance, the largest gap between the two, and which is not as severe?
Good question. I would say, so if we look, and let's call it the medium term. So if we look out 5 years at the supply demand forecasts for a bunch of the metals, I'm not going to talk about gold because I don't think supply and demand applies to gold. So that's over on the side. Silver has a really significant deficit. And I say that with that, having said the thing about gold right before, because silver, as much as silver is an investment thing, it is primarily an industrial thing. And the photovoltaic solar cells use a lot of silver. They have to use silver. There's no alternative to silver in photovoltaic cells. And the net zero scenario by 2050, that roadmap has photovoltaic cell installations increasing over the next 10 years to the point that 10 years from now, solar cells will eat up all of the silver that the world is currently producing without leaving any silver for all of the other things that currently use silver. For context, right now, silver only uses about 10%, or solar cells only use about 10% of the world's silver. So in 10 years, silver is supposed to go from solar demand for silver is going to go from, using today's production numbers, 10% to 100% of the market. So that clearly doesn't work. And that doesn't account for things like the fact that it looks like they're increasing silver loadings on solar cells because it's worth it despite whatever happens to the price of silver because of the efficiency that it adds to, or the efficacy that it adds to those solar cells. So silver is a really interesting one. Copper, as much as it's as boring as all get out, I say boring as all get out, it's the PhD of metals, right? So when people are sort of looking at economic health, they look at the chart of copper, and that's used classically as an indication of the health of an economy, especially the industrial side, obviously. So it's a bit boring. It's a big market, But man, the supply deficit for copper is really big. And I think copper, as much as maybe more than any other metal, really tells the story of new mines not being built. And I'll just quickly explain. I think there's 3 reasons why we haven't seen, why the number of new mines, especially large new mines being built each year, has fallen off dramatically for the last 10 years. And those 3 reasons are: first, investors haven't been interested in the space. They've been interested since the great financial crisis in other opportunities in the stock market for all kinds of reasons. So investors haven't been interested. Management at mining companies have not been aggressive. And that it was good for a time, because management at mining companies screwed up royally in the last bull market for metals by overbuilding. And that's one of the reasons that we had such a long bear market for metals, because they oversupplied, they overspent, they overbuilt, they did a bad job of managing capital and opportunity. So they really turned 180 and became very conservative. And so you didn't have investors interested. You didn't have management at mining companies interested in going out and building big new projects. And permitting has become excruciatingly difficult to build the kind of significant mines that are going to change the balance in the copper space. And so, because copper, most of the world's copper comes from porphyry deposits, which are pretty darn low grade. Also, a porphyry deposit used to be maybe 1.2% copper. Now, porphyry deposits, they're on average being mined in the world, maybe 0.5%, if you're lucky, 0.4%. So we've mined out all the good ones. It's harder to permit to build big ones. This is why copper supply is becoming so fraught. And so copper is really in deficit. And of course, I mentioned the green transition being sort of the engine for this base metal deficit. And that's because you can't replace copper. Copper is the only thing that we can use to move energy around in the new, green energy world. And so copper and silver are the 2 that really stand out. Now, uranium also has, I think, very exciting days ahead. It's a bit of a different market, but it also is very exciting. Of course, we're trying to reduce emissions. Nuclear reactors are, in my estimation, and from everything that I understand, the way to create baseload power that isn't beholden to sun or wind or other things, consistent baseload power that doesn't create emissions, that is safe, and that is clean. And this has become accepted politically and socially in the last few years to a degree that has never happened before. I'm not saying that everybody loves nuclear. Obviously, there's still a lot of opposition to nuclear power, but the shift towards supporting nuclear in the last few years has been real. It's been tangible. It's been very real. And now that you've got politicians actively on board promoting nuclear, now that you have small modular reactors clearly capable of being the power sources in places that don't have other opportunities other than dirty coal, nuclear is really coming into a new age. And guess what? We don't have enough uranium mines. So I really do think that there's a big opportunity in uranium instead. So those are the 3 that I would highlight: silver, copper, and uranium.
But I know you interviewed Amir Adnani on YouTube channel. I had him on a Twitter space, and I'm fully down with the uranium argument, but the patience has got to be high, because that just does not want to have consistent momentum on a chart, but that's short term.
Yes, for sure. Oh, I know. I've been waiting for this uranium market for longer than I want to admit.
Yeah, no, exactly right. So let's. Okay, so again, you're obviously extremely knowledgeable in the space. You got tremendous passion. You've got your research. You got your newsletter. I got to assume you find it frustrating that maybe a lot of other people don't share the same degree of passion and knowledge that you do. In cycles where there's not much going on, you've lived through it, but how do you keep yourself positive? I mean, I'm assuming that you're doing more than just investing and trading in space, even though you believe in it very long term. So what are you doing during those kind of, doldrum quiet periods?
Yeah, it's a good question. I mean, even right now, excuse me, even right now is a bit of one of those. I'm a little bit, it's hard to be motivated, because the gold argument is sort of on pause until we have some concept that rates are going to come down. And the base metal argument, we're still sideways until there's some confidence that we're in a growth phase. So again, right now I'm sort of twiddling my thumbs on the metal side of things. What's cool about having grown up through the mining space is that it's speculative investing, right? Especially the juniors, right? When you're looking on the discovery side of things. So there's a lot of other applications or other sectors where the same criteria, different but same, apply, right? Where if you want to look at biotech or if you want to look at tech ventures, the same kinds of criteria apply, right? You got to start with the people. You got to understand that capital market, their capital markets plan, how they're going to raise, what they're going to do with it. So the same sorts of criteria apply. And basically, I spend my time trying to gather expertise in some of those other arenas, because even though I'm really expecting a metals bull market to take up the majority of my time for the next few years, once it gets started, then it will turn down again because metals always do. And so I do need to have expertise in other areas, and I just try and spread that. Yeah. Make my knowledge helpful, help me learn some other arenas.
What's your biggest piece of advice for those that are trying to really understand the fundamentals of the metals and mining space? I mean, everybody always does the same thing. They always look at a chart. They might argue about fundamentals, but they buy and sell based on squiggly lines, as I call it. What do you find, just from your experience, people miss when they analyze the space?
I think there's two sides to that question that I'll answer separately. On the junior side, I often get people talking to me about the squiggly lines, to call them that, of a junior exploration company. And while they matter, they also don't, because this is a very illiquid market relative to, a lot of the other stocks, most other stocks, to be honest. The volumes that are traded are very low. And so you can't apply the same kind of totally chart-based approach that you can to other things. Obviously, the chart still matters. Obviously, you want to pay attention to what's going on with the price, but you can't apply the same chart-only approach because it's so illiquid that the volatility is way higher. And so that matters. So if you're going to enter into the junior space, you can't do it as a chart first approach. You have to do it as a fundamentals first approach, and then chart helping you time your entries and exits. But it has to be the fundamentals of the stock first, because that's just the way it has to be in a highly volatile, illiquid, discovery based space. So that's on the junior side of things. On the major side of things, I mean, the squiggly lines are important, and there's no point investing in, anywhere from a company that's just built their first copper mine through to the largest gold miner in the world. There's no point investing in those mining companies unless you have a rationale for why that metal, whether it's the copper or the gold, is going to go higher. You want the squiggly lines of the stock chart can give you certainly an indication of that. Probably a pretty good indication. So that's a good starting point, but you definitely want to understand your metals thesis and then start looking at the squiggly lines to see if you think the broader market is as in on that thesis as you are. Because that's the other thing, right? Sometimes we come to conclusions before or maybe after, but not synchronized with other people.
Gwen, for those that want to track more of your work, where would you point them to?
Absolutely. So my website is resourcemaven.ca. You can find my contact information there, or here on Twitter. Absolutely. Mining Maven Gwen. And I love chatting with people. So if anybody has questions, I would love to connect with you. Send me a message on Twitter or come to my website, check out my newsletters. I would love to help any of you who are interested in learning more about the metals and mining space.
Thank you all for joining, and enjoy the weekend. Thank you, Gwen. Appreciate it.
Thanks so much to you. Thanks for having me.
All right. Cheers, everybody.